Okay, let's start. Hello, traders. Nice to see you. Nice to see you on our meeting. Today, this is a kind of a premiere. I'm making a webinar for CCI traders. I hope that everything goes well. If there are any problems, I hope that the technical will give me some information. Let's start with this. Thank you. Hello. So let's start this way. I will show you some interesting, I believe, bullish candlestick patterns, which every trader should know. And then at the end of the session, we'll make a question and answers session. So during the webinar, maybe I'll not interrupt the session, but at the end, you can ask questions. I will answer to the questions. I hope that there'll be enough time so we can go to some samples on the live charts. What's happening now, because I see there are some opportunities on Australian dollar, on Japanese yen, on pound. So it can be also interesting to check if those bullish candlestick patterns can be used at the moment on the live market. So I believe that this is the most important thing to get some theory and then to check it on real charts, not to just stay on a theoretical part of the business, but also a practical. So it means that we are trading and we are making profits. And to do it, of course, we need to have some theoretical ground. So let's start with this. Just a few words about me. I'll close the chat room. This is me. My last picture from a month ago. So it was before the coronavirus problem. So I'm a trader. I am trading over 10 years of Forex market. I was before I was trading stock markets, the DAX, the S&P 500, also the contracts for difference. But the last 10 years I'm trading Forex market. I believe Forex market is much easier. You don't need so much. You don't need to read so much. You must read the prospect. You mustn't read the documents or the white papers. Just focus on the charts and some fundamentals, of course, because many currency pairs or commodities are dependent on fundamentals, especially oil, gold, Japanese yen is also sensible for fundamental news. So let's go on. Of course, I need to show you this disclaimer, because this disclaimer is a kind of a risk warning that you need to, if you want to trade, you must be aware of a risk which is during this trading, and you must also remember that past performance may not be indicative of future results. So let's go now on to the next part. So as you know, the sponsor of our webinar is the company CCI Traders, and I hope that you will like them. It's our partner, and we are cooperating. We're hoping to help the traders who are the customers of CCI Traders to get some education and become a better trader. Of course, as you know, there's a special offer from the CCI Traders. They offer interesting solutions. They give a $50 free bonus for the beginners to start the first trade. They give also a bonus 50% to traders who make their first deposit or replenish an account. Also a multi-account manager, and beginners traders who want this bonus, please send your apply to the mail support@ccitraders.com. So you can also apply for other bonuses via the client cabinet. Okay, so those are the formalities. Now let's go to our main subject. Those are bullish candlestick patterns, which I believe every trader should know. Maybe most of you already know those things, but I believe that I'll just check here. volume. Is it you don't hear? What can I do with the microphone? Sorry. Is it okay now? Do you hear me properly? I hope so. I hope so. So, as I just coming back to the subject, bullish candlestick pattern. Those are patterns made from candlesticks. Of course, those candlesticks are Japanese candlesticks. Those are specific. It's a specific way of yeah. Fine. Thank you. Bye. Elizabeth is satisfied with the Zoom. That's fine. We can continue. And now let's go to one important thing. The candlestick patterns are used to predict the future direction of price movement. Prediction is not to be, if we predict some direction on the market, it's of course not something which is sure for 100%. But in most situations, we have a chance that if we analyze a special pattern of candlesticks, we can expect that the move will be up or down. It's very important because, as you know, the only question on which we would like to hear the answer is where will the market go? If we would know in the morning where the market will go in the evening, we would make profit very quickly. So from one side, it looks very simple. One question, will they go up or they will get down? But the answer is much, much more difficult. And the biggest problem is that the market is not answering us straight away. We need to find the answer ourselves. So I will show you the most vital patterns, two, three candle patterns, which can help us to identify where the market is gonna move. So it will help us identify the trading opportunities. Leo, so as you know, there are many patterns. We will be discussing today this part of this chart because there are, as you see, bullish candlestick patterns, they are neutral, and they are bearish. If we compare bearish candlestick patterns and bullish, to say the truth, it's nearly the same, just only opposite. It means that they happen in opposite situation. So if we discuss today the bullish candlestick patterns, I believe all of you will understand that the bearish are just happening on the opposite way. The neutral, it's another discussion for the neutral because we can say that the neutral happens especially in the consolidation, but the consolidation is a part of the market which happens, of course, very often. But I believe for us more important are bullish patterns which are showing us that the market will move in some way. And what's important? If we find the direction, we are profiting from that. So I will focus today mainly on hammer. I will focus on bullish engulfing. I will focus maybe on morning star, three white soldiers. Just a moment, and you will see all what we want, what I want to show you. So let's start with this. So bullish pattern usually is formed after a market is in a downtrend, and it heralds that a reversal of a price movement can happen. It's for us traders, it's a signal which when we see, we can consider opening a long position just to take a profit from the change of the direction and a bullish move of price. Candlesticks, we have different candlesticks. We have reds, we have green, we have black, we have white. It all depends on your platform which you are using to. In the case of this seminar, just to keep it as a one standard, let's say that green color means that the candle is bullish, and red means that candle is bearish. So this is our standard for this webinar. And what you must remember, that if you open another platform, you can change the colors. You can have a black background, and candles can be white and black. It all depends on you. But always remember that we have bullish candles and bearish candles. Bearish means that the price started here, and at the end of this candle, it finished here. In case of bullish candles, price started here and finished here. What means that if this is, let's say, daily candle, which is showing us the movement of price during the day, you can say, today in the morning at 12, or let's say 12 in the night, midnight, the price opened at this level. And when the day was finishing, it closed here. But before, it was also, this was the maximum of the day, but the price came back and the day was finished here. So we had a bullish move through the day. And here is just opposite. Midnight was here. Then the price was growing up, let's say, during the Asian session. And then it started coming back. But at the end of the day, after the New York session was closed, the market finished here. So this is the way the Japanese candles are showing us how the price was moving. So here we have the maximum of the day. Here we have the low of the day. And this is the closing price, and here's the opening price. So this is how the Japanese candles are built. I believe you can find in the internet a lot of articles showing this, because those are basics, and I hope you already those basics know and you understand them. So let's start with the first important, very important candle, which is called a hammer. A hammer looks like this candle. This is a one candle pattern, and this is called a hammer. Hammer, it goes, why? Because it looks like a hammer, okay? Here's the handle, here's the hammer. What is important in the shape of this hammer is that we have a long wick and a small body. Sometimes it happens even that the body is to the end of the hammer. So it means that the body is like this, and then we have this wick. Because, as I mentioned, this is the body is the part of the candle which is full, and those things up and down, those are wicks. Okay, those are, the wick is this line here, and this is the body. So, and what is important, that those hammers are usually found at the bottom of a downward trend. Maybe I will show it on a bigger picture. This is the one. This is the next picture. So this is how it looks on a chart. We have a downtrend. The price is falling, falling, falling. Some corrections, and then at the end of the move, we see something like this. This is the hammer. In case of this hammer has a wick over the body and below. But what is the most important thing is that the wick must be much longer than this body and this wick over. So in this case, we have a full body hammer, but of course it can have a wick here. It's not a problem. The most important thing is this wick, which must be really long, and the minimum of this candle must be the minimum of this area. So it means that if you see something like this inside the move, it's not a hammer. You see, this is not a hammer because it has a big body and the same size, we'll say. What's important in hammers, they need to have a long wick. Okay, and this is a hammer. It shows that there was a selling pressure because the day started somewhere here. There was even a gap, and the price went down. There was a selling pressure. The day was sold out, and at the end of the day, they started pushing the price up. What means that sellers, which were here sellers, got weaker, and the buyers got stronger. So this was the moment when the wick was happened, that was built. Selling, buying, and that's why we have such a long wick here, or sometimes we call it a shadow, but maybe wick is better. And the price finished here, so it means that the sellers are no more stronger than the buyers. The buyers are stronger than the sellers. That's why it's a sign of bullishness on the market, and this bullish hammer can be a kind of a prediction that the market will start growing. What's important here in this shape of this candle? This is, as I mentioned, this is one candle, single candle pattern. is that we can call it also a pin bar, because there are different names, there are different stories about forex. I call it a pin bar, but also we can call it a hammer. So one small hammer is a candle with a very long wick below, small body, and bullish. When it's bullish, it means that it is a sign that all those sellers who were selling gave up here. They gave up because the buyers started buying and pushed the price up. And that's why it's called a bullish pin bar. So we have two names for those. Hammer is a type of a bullish pin bar. Okay, so this is, let's say, the first, I believe, one of the most important patterns, or let's say single candle patterns, a bullish hammer. But also we have another candle very similar to this one. The only difference is that this body is below, and here we see a wick over. So let's say that hammer looks like this, and this is just an inverted hammer. Inverted hammer is very easy to spot it because it's a very specific shape. Must say that those inverted hammers don't appear often, but still they also are found on the charts. And what's important here, we need to spot them, because it's very if we spot them very soon, we have big chance to enter the market enough quickly. So sorry. So the only difference between hammer and inverted hammer is that the wick is long and the lower is short, or there's even any. What it means, we saw that the market was sold out, so the sellers are very strong here. And then what started? The market closed, let's say, on Tuesday here, and Wednesday started growing. So it was bullish, went up, then was pressed again down by the sellers, but the sellers didn't manage to push down lower. I'll see what's here.